high yield dividend ETFs or listed investment companies. What is up everyone, it's David here. In this video, I want to talk to you about high yield dividend ETFs and LICs, and in my opinion, which one is better if you're a dividend growth investor in Australia. At the end of this video, you should have a really good understanding of the key differences between the two and also which one will have a better return over an 8-year period. But if there's one thing that performs better than both LICs and ETFs, it's gently smashing that like button, because that will feed me enough to keep creating videos for you.
That's a horrible joke.
Now without further ado, let's go. Okay, so when it comes to high yield dividend ETFs and also listed investment companies, there's really just three main differences. There is the structure, tax implication, and also management style. Management costs can also be a big difference between high yield dividend ETFs and also dividend focused listed investment companies. Because high yield dividend ETFs are actively choosing what stock is going inside that portfolio. So there is a lot of buying and selling. Now to give you some perspective, three of the largest high yield dividend ETF have management costs anywhere between 0.25% to 0.34%. Just for your information as well, IHD is BlackRock's high yield dividend ETF, RDV is Russell Investments high yield dividend ETF, and VHY is Vanguard's high yield dividend ETF. Now, if you compare that to the three of the largest dividend growth focused listed investment company, which is Australian Foundation Investment Company, Argo, and Milton Corp, their management fee ranges anywhere between 0.12% to 0.16%. which is approximately half of what you'll pay for a high yield dividend ETF. Now don't worry, for your entertainment purposes, I created a hypothetical portfolio where I invested $10,000 in each of the ETFs and LICs I just mentioned, and you get to see how much that investment is worth today if we invested in the beginning of 2012. More on that in just a second. Now let me quickly elaborate on the three key differences I just mentioned when it comes to ETFs versus LICs. So ETF is a trust structure, whereas listed investment company is a company structure. So that means when you invest in a listed investment company, you're essentially buying a share in a company. And that company has a board of directors that determines how much dividends is paid out every year and also how much cash they can hold in the company as well. So what you'll find with listed investment companies is that dividend payouts are usually pretty smooth. It's not very lumpy and all over the place. It's a pretty smooth dividend payout that's growing year on year. Now, on the other hand, because ETFs is a trust structure, they have to pass on all dividend income to you as well as the capital gains and losses when they are rebalancing the portfolio. Now, with the points I just mentioned, it's not a good or a bad thing. But if you care about dividend payout consistency, then high yield dividend ETFs will have more of a lumpy payout over the years, whereas listed investment companies will have more of a smooth dividend payout process because they can choose how much to pay out every single year. Now, the second main difference when it comes to high yield dividend ETFs and also listed investment companies is tax implications. Now, if a listed investment company receives unfranked dividends, which means that the company that's paying the dividend didn't pass on the tax credits, the listed investment company will have to pay tax at the company tax rate, which is anywhere between 27.5% to 30%, in order to deliver fully franked dividends to you. Whereas high yield dividend ETFs will pass on all of its tax obligations to you. Now, the good thing is most high yield dividend ETFs in Australia pays partially franked dividends. So you still get your franking credits, but you just might have to pay more taxes in your own income tax bracket. If you need professional advice, make sure you go seek out a professional, because at the end of the day,
I'm just a bald Asian guy making investing videos on YouTube.
Now, a few of you have also asked me specifically to cover tax implications for dividend investors. So if that's something that you want me to create a full video on, make sure you gently smash that like button. And if this video gets 300 likes, then I know that there is enough demand to create a full video on that. Now, the third key difference when it comes to a high yield dividend ETF and also a dividend growth focused listed investment company is their management style. Now, typically for a big LIC like Australian Foundation Investment Company, Argo, or Milton Corp, they mostly buy and hold stocks because they're looking for a sustainable long-term dividend growth stock. So the trading activity is pretty minimal. Now, on the other hand, with high yield dividend ETFs, there is a lot more buying and selling. Okay, so I want to make a quick note here. Now, if you look at turnover rate for a high yield dividend ETF like VHY, they have a turnover rate of 22%. So what that means is that over 22% of the portfolio over the last 12 months have been bought and sold, compared to one of the largest listed investment company in Australia, which is AFI. They only have a turnover rate of 11%, which means that 11% of their portfolio over the last 12 months have been bought and sold. Even though they are tracking a high yield dividend index, as the dividend yield changes or a stock no longer fulfills the criteria, they'll have to buy and sell those stocks into the portfolio. So there's just a lot more buying and selling when it comes to high yield dividend ETFs, and this is one of the main reasons why their management cost is also higher. Now, between the two, high yield dividend ETFs tend to have a lot more active management style versus LICs. Even though they are actively selecting, they are a little bit more passive because they're buying and holding over the long term. Okay, so now that we've got the key differences out of the way, the main question is, how does a high yield dividend ETF stack up against dividend growth focused listed investment company? So for this demo, I picked 3 of the biggest high yield dividend ETFs I could find, which is IHD, RDV, and also VHY, Vanguard, BlackRock, and also Russell Investments, against the biggest dividend growth focused listed investment company, and that's FI, which is Australian Foundation Investment Company, Milton, and also Argo. Now, a couple of things to note here before I show you the results. Now, the first thing is I hypothetically invested 10,000 Australian dollars in each of the ETFs and also listed investment companies I just mentioned. Now, I avoided all property REIT ETFs and also any dividend harvest ETFs because the strategy and the asset class is so different compared to listed investment companies. It's really comparing apple versus oranges. Now, all dividends paid are reinvested for compound interest reasons. And also, the final point I wanted to make is that I wish we have a longer time horizon to compare. But the thing is, most of the high yield dividend ETFs were created in 09 and 010. So this is the best I can do. So the total $60,000 we hypothetically invested in the beginning of 2012 will be $107,271 on the 27th of May, 2020. So that's a 10.12% return per year, and with a 8.64% dividend yield, that's pretty good. So we should dig into the portfolio and see what's under the hood. Now, this is where things get pretty interesting. The listed investment companies produced a total of $25,574 worth of dividends over the last 8 years, whereas high yield dividend ETFs produced $29,935 worth of dividends. So that's 17% more compared to listed investment companies over the last 8 years. But this is where the story takes a turn. If you look at the total return, listed investment companies in total, including capital gains, have generated $38,828, whereas high yield dividend ETFs generated a total of $26,189. That means over the last 8 years, listed investment companies generated 48% more in total returns compared to high yield dividend ETFs. If I stop this video right here, then it's intellectually convenient to say that listed investment companies are better than high yield dividend ETFs. But the thing is, there's a place for both. For someone who only cares about income and don't really care about growth, high yield dividend ETFs could be something worth considering. But on the other hand, for people like me who value sustainable dividend growth over time and are a massive cheapo, I personally prefer lower cost, smooth out, fully franked dividends that will grow with me over the next 20 to 30 years. I'm obviously biased because majority of my portfolio is dedicated towards listed investment companies, but these videos are my findings and observation based on the facts I could find. Now, if you want to try this experiment yourself, I use ShareSite to create the hypothetical portfolio. So I'll leave a link in the description below if that's something that you want to try for yourself. So the easiest way to create a hypothetical portfolio is via ShareSite. I'm not sponsored by them. I just use them for my own portfolio tracking purposes, and I found them to be super helpful. And also, all of the performance metrics and data points are live and they're using real market information. So when you create these hypothetical portfolio, it's as real as it gets. And you can even take into account transaction costs as well. And of course, reinvesting all the dividends. So it's super, super powerful. Now, if you're going to create this, I just want to give you a quick tutorial on how to do it. So whatever hypothetical portfolio you want to build, you just want to add new holdings. You go find your stock. Let's say we're investing in AFI. Now for the video that you're watching, I chose January 2012, but it's really up to you in terms of choosing what time frame or time horizon you're going with. Personally, the longer the better. And then there'll be a unit share price on that time, which is really, really freaking awesome. So I just chose the share price at the time. And then you basically want to add enough quantity that will make up to about $10,000 or whatever hypothetical amount you want to do. And then once you're done with all of that, this graph will start populating with the stock. And if you want to reinvest your dividends, you just click into the holding, you go to holding settings, you turn on auto dividend reinvestment, and then there will be a confirmation button here where basically it's confirming all the dividend payments. And if you reinvest all your dividends, you'll see your portfolio getting adjusted based on the options that you chose, whether you have reinvested the dividend or you didn't reinvest the dividend. So that's a very short tutorial on how to create a hypothetical portfolio on ShareSite. But let me pose a question to you. What do you think? Is there another obvious benefit that I overlooked when it comes to high yield dividend ETFs? Let me know in the comments below, because I would love to read your feedback in terms of whether the comparison was fair, whether it wasn't fair, or whether there was a obvious benefit when it comes to dividend ETFs I just completely overlooked. Now, thank you for watching this video all the way to the end. It really lets me know that you enjoy content like this. So as usual, make sure you gently smash that like button, because that really does help out my channel out a lot. And also subscribe to my channel, click onto the bell, so the next time when I release a portfolio update or talk about market news, you'll be the first one to know. And Auto will do the honors. See you next time.